Welcome to this episode of Zero K. 2022 is upon us, so we thought it's a good time as any to discuss macros, to look for both the forests and the trees of the economic framework and take a trip around the world to see what's happening. In this journey, to help us out, we have Mr. Debashish Bose, the Managing Director of Oaks Asset Management. He has a broad and deep understanding of the subject, and with him on the episode, we discuss a lot of points about macros. We discuss quantitative easing, economic repression, changing role of central banks, changing role of technology and the economy as a whole, cryptocurrencies, and much more. So we hope you go through the entire conversation and find something useful. And as always, enjoy the conversation. Welcome, Debashish. So good to have you on our show. Thanks for joining.
Hi, Sahil. Good to see you.
2022 is upon us. Possibly one of the best times to be talking macros. But like we always do, let's begin with you, Debashish. Your time at IIM Calcutta, how did you get into finance? What roles did you have? All this journey, how did it play out?
Kind of happened out of elimination more than anything else. I was at IIM Calcutta. I wasn't particularly sure which direction I wanted to go in. I ended up doing my summer internship at Coke, which was an interesting experience in the 50 degrees weather in Delhi in the summers. And I pretty much figured that if I do have to bust my balls doing something or the other, it's better to do it in an air-conditioned office in a different scenario. And that's pretty much how I defaulted into finance. I started out working at Kotak in the Kotak Mahindra Group as part of the private client team in Kotak Securities. Kotak Bank didn't exist in that time, so all of that was done there. And again, I ended up joining that group more because it just sounded like a cool thing to do, coming out of college and, just interacting with a very different section of society, which, compared to what you're used to. So that's how it all shaped up. I spent time in India for about 4 years, looking across various asset classes, managing some money on behalf of clients as well. Then in 2004, I moved to the US with Kotak, where I worked with a lot with institutional clients. I shifted from there to a global bank called UBS, where I was actually doing Asian markets at the time. So which was almost like a ringside view of what's kind of going on all around the world. And it led right into the crisis as well. So one couldn't probably get a better education. I started with the NASDAQ crash and then I went into the financial crisis. So it was interesting. Post that, worked quite a bit on global macro. I was with a firm called Quant Capital who was wanting to move in that direction. It just made a lot of business sense for us also than, just trying to be an Indian firm. We just thought, let's play for a much bigger part of the pie. So did a bunch of that. We also did what's today popularly known as smart beta. We were effectively doing those things back in the day. Then I spent some time in a couple of asset management firms in India, one being IDFC and followed by DSP. In fact, I got to meet Nitin, your founder, when I was at IDFC. I had launched a couple of ETFs at the time, and I think, for an ETF business to take off, you need three things. You need, a really easy way to open an account, which Zerodha was trying to solve in those days. This is still, the early days. Secondly, you need a market maker ecosystem. And thirdly, you need institutionalized client bases. Now, when the institutionalized clients would come, that remains to be seen. But I figured Zerodha would be the one firm who would understand the market maker ecosystem and and that's how we got in touch and, got to know each other a little bit over time. So, and it's been remarkable to see how you guys have progressed over time, the business model which you have taken up and how it's been very unique in the ecosystem. And I just think a lot of your competitors who are trying to copy you still haven't figured that basic thing out.
That's very reassuring. That's really reassuring. Yeah. What an amazing journey you've had until now. And it's only going to have the future. Let's talk about the future. You've picked a very interesting time to start a fund. Possibly one of the most important, turnaround times in history. So how was the experience in terms of deploying money, talking to investors, gaining their trust? How did it all come about?
I'd say all of that is still work in progress because it's only been about a year since we started out. But conceptualizing this and actioning it, it's been something which, has been in my mind for a long, long time. In fact, even when we describe what we do in the fund, we really say, I think India is where maybe China was in the 90s, late 90s, or maybe the US was in the 1950s, but with Wi-Fi. So it's just recreating what was happening there with the obvious changes which happen, the obvious progressions which happen when you bring in digital technologies as well, and which means, it just makes for a certain amount of things which you can directly download from history and apply, copy paste, and at the same time, applying what's going on globally to what was the historical sort of precedent and how that may shape things going forward. It just means that, both of us are simply at a very unique stage in our life, and not just the two of us. I think pretty much everyone who's sitting in India at this point in time.
Understandable.
It's also pretty interesting. It coincides with people wanting to go outside India and study. I mean, that's been increasing. So exactly the time when these things should start going the opposite way. That's how I see it.
Let's talk more about Oaks PMS. What is the investment strategy? How did you align macros in your portfolio? What is the theme going forward?
So what we do at Oaks is we first try to figure out what not to do, which is our offering is, of course, intended for a particular section of the investor base, which is, I would call it the ultra high net worth, the family office, that kind of segment, where it's the access to all kinds of managers is already there. The experience of having invested in markets is already there. And they most likely in their portfolios, they're pretty much allocated across the board. So what we really have to try and pick is what is it that most of the managers are potentially not supplying, and can we sort of do that and fit into their overall allocation. Now, my strategy may be completely different if I was looking at a different audience, but for this particular audience, that's how we went with it. And when I looked around, I really saw that there were a set of sectors which every portfolio is allocated to. All of us can pretty much reel it off, like it's got the private banks, the insurance, IT, pharma, all of these things. For good reason, they've done very well over the last decade or so. They used to be about 30% of the indices back in the day. Today, they're almost 80% of the indices. And that's exactly what's reflected there. So the starting point for us is we will not touch those sectors. Simply because you can buy even a simple ETF and get that exposure today. So let's look at the other sectors.
Got it.
And then try and build a concentrated portfolio around it, which is capturing transformative trends happening in those sectors. Now, those sectors may be relatively undervalued because they're relatively underowned, but just undervalued, to my opinion, in a growth market like India doesn't make sense. You've got to find the combination of being undervalued and where the growth could come from. That's where transformative trends play out. And that's where we jump into this whole rabbit hole of macro and everything. Because the only way you can figure out trends is if you really go deep across the macro elements of what's going on globally, what's happening in India, how tech is shaping pretty much everything, what's going on. And we kind of use that to arrive at the strategy and construct the portfolios with that.
Interesting. That's fair. That makes sense. So now we begin on the macros.
Sure.
So let's begin. To set some context for the listeners, we had recorded a webinar in what world looks like in July 2020. So this was peak panic in the markets time. We'll link the video in the show notes. The listeners can go through that. So before we dive into the questions, can we get some context as to how the world looked pre-pandemic until now? Because there has been tremendous change in the past year or so, and our brains aren't built to process all that so quick.
Yeah, sure. So when we were looking at things, and I think when we recorded that video, and it was part of a series of such recordings which we were making at the time, I think that post-pandemic era was just starting to play out, where we really talked about the fact that, yes, there's a lot of money, there's a lot of liquidity, re-leveraging will happen. And most likely asset classes do end up doing pretty well in that scenario. And down the road, you probably see some elements of inflation also coming in. I think fair amounts of that have played out. I mean, of course, there is a thesis which you give, and how you actually trade it can always be a little different, and that you sort of have to look at it on an ongoing basis. But more importantly, going into the crisis, I think the signals which were there at the time was that you had interest rates coming down over a period of time as a result of a bit of a slowing sort of economic system. The bond markets were clearly signaling that. At the same time, the stock markets were in a bit of a euphoric move up till at least Jan or early Feb of 2020, so going completely divergent. And therefore, somebody had to be right? I mean, I think the pandemic, or let's say if I were a central banker and looking into that situation, it would tell me that the economy clearly needs help. But in the midst of a roaring equity market atmosphere, how do you go ahead and start doing, recovery work on the economy? It just wouldn't make sense. So you almost were wanting a crisis to happen. Now, the fact that the crisis would be a pandemic, I don't think any of us could have figured that out. But the fact that there could be a crisis, which would then give the air cover for central bankers to go ahead and do what they needed to do, I think that much was pretty evident. And that's pretty much what you saw post the crisis. Today, they are talking about tapering and all those things, but I think the scenario is fundamentally different from what it was when the taper tantrum happened in 2013. In 2013, what was going on going into the taper was that people were, again, betting on inflation. At the same time, interest rates were also starting to move up. At that time, there was still a linkage between interest rates and inflation. And then you had someone like a Japan completely reversing its currency policy, and therefore effectively moving from a sort of, strengthening currency policy to a depreciative currency policy. And that completely changed the game, because you had a world position for inflation, but you had a key actor in that global system who was going to pursue a weaker currency and therefore create, export their deflation to the rest of the world. And because what Japan does is, Germany does very similar kind of businesses. So Germany would have no choice but to do the same thing. And the likes of China and Korea also do, similar kind of activities, and they would have had to do the same thing. So effectively, the euro, the yen, and the Asian currency basket would broadly start weakening. For a world which was positioned for inflation, you had this big deflationary force coming. So clearly there was a readjustment of the world which happened at the time. Now, where we're sitting today, it's a little different. In fact, it's a remarkably different scenario. Let's start there. The first thing is that I think we're about to see a delinking of the historical relationship between interest rates and inflation. So which means we can pretty much throw out all the textbooks we have so far and go into this brave new world. What that means is, let's say inflation is at 6% for hypothetical purposes. I mean, it is somewhere around there. And we have interest rates at about 1.5%. Now, this isn't just happening by default. I mean, this is pretty much happening by design. The reason for that, and why don't I share something and that'll recap what I was talking about last time.
Please.
So, this is an aspect which I touched upon in my previous presentation, that what we know about equities and markets is almost dwarfed in size compared to what we don't know. What we typically see is the global equity markets, of course. We analyze a lot about what's going on in global GDP, but the fact is that these are almost inconsequential in size. And on the other hand, the more leveraged part of the economy is significantly larger. I mean, we do have a decent idea about the global bond markets, but that's significantly larger. Global real estate, a lot larger. And then we look at, this thing called derivatives, which is maybe 15, 20 times the size of the global economy itself. Now, the issue is that when you run into this scenario where you want to, get your economy growing, and at the same time you keep a clear link between interest rates and inflation, there's a decent chance that if your policies work, there is a decent chance inflation will also happen. Mm-hmm. But if inflation happens, theoretically, interest rates should go up. But if interest rates go up, they will create problems in a highly levered economy. And when we look at, especially when we look at these derivatives, the derivatives I'm referring to are interest rate swaps, which are typically traded between institutions, where one is saying, taking a particular view and somebody else is, giving him that.
Synthetic derivatives are back in action after 2008. They're back. They just won't leave us.
They're not just back, they're far bigger.
Okay.
Yeah, they're far bigger.
They're back with a vengeance.
Yes, pretty much. And this time, maybe even countries are in play. It's not just about a housing market. Mm-hmm. So this is still pretty much there. This gets amplified even more because you've had this whole last decade of low rates, which has meant that a lot of volatility has been sold in the form of various kinds of options on, various things. Effectively, the whole world is, to a large extent, short volatility in various points in time in terms of their portfolios. Now, a lot of times these derivative trades, the collateral which they use is typically the safest of bonds, typically government bonds, and mostly the government bonds of the biggest markets, which is the US and to some extent Europe and Japan. Now, if you have a scenario where the bond yields start going up, and that I mean the mid-term to long-term bond yields start going up, then effectively your collateral starts dropping in value. Mm-hmm. If your collateral drops in value, you can really have sort of apocalyptic events from time to time. Now, no one really wants to walk into apocalyptic events. I mean, they may happen anyway, but ideally you don't want to go there. So that's why you are trying to create a certain amount of growth, but at the same time trying to put some kind of a cap on how far interest rates go up, or more correctly, how far bond yields go up.
So it's a balancing act that's going on.
That's right. That's exactly what it is. And which means that you kind of have to play this game of financial repression, which is where you let the yields run much lower compared to where the inflation rates are. What this does is then every time the government issues...
In your tweets, you've spoken a lot about financial repression. This isn't a very used terms in today's terminologies. So could you explain to us what financial repression is?
Absolutely. So what I just described, that let's say hypothetically interest rates are 1.5% or so, say on the US 10-year bond. And you've got inflation, say, running around 5.5-6%. So therefore, every time the US government were to issue a 10-year bond, you are effectively, it is paying an interest rate which is, say, 3.5-4% cheaper than what it should. Mm-hmm. Or maybe even 4.5% cheaper than what it should, right? So effectively, it is transferring money from the saver, which is the investor in the bond, to itself every time it issues a bond. And then it uses that money to keep trying and buying back a certain amount of bonds in the market. So doing that over a period of time, you hope that you de-lever at least bring down the leverage levels in the system. Because right now, the leverage levels are so high that it will create those apocalyptic events from time to time. That's really the other alternative, which is really no alternative. It really is a systemic collapse.
There's no avoiding it.
There's no avoiding it. Exactly. So what you try to do is try and push that problem away as far as possible. If bond yields were to move up pretty sharply as what we saw in October, if you can find a way to talk it down, that does the job. Maybe this new virus variant is a way to talk it down than anything else. And I think we've seen what's happened over the last month and a half, that the bond yield came off from about 1.75 to about 1.4 or somewhere there right now. Equity markets have obviously cooled off. Commodity markets have cooled off. So in some ways, that whole pressure of inflation is kind of off the table for now, which means they don't have to take that next step of financial repression, which would be that hypothetically, if they were not able to pull this off and the bond yields kept rising, then at a particular point, they would have come in and said that, look, we are not going to let bond yields rise further than this. So let's say bond yields reach 2.5% instead of the 1.5%, which it is today. And the worry would be anything rising more than that could create all kinds of, explosions in the financial system. So then you follow a policy which is known as yield curve control, where effectively you buy unlimited amounts of bonds at that particular yield. And unlimited amounts of bonds at that particular yield. You basically don't want the price to go up. So that's what makes it different from quantitative easing. Quantitative easing is saying, okay, I'm going to buy a fixed amount at some designated point in time. And therefore, liquefy the system and at the same time keep rates relatively low.
The money machine keeps going.
Yeah, keep the thing going. In yield curve control, you say that, okay, I'm going to buy unlimited amounts at this point in time. I'm going to buy unlimited amounts at this particular yield, so that the price and the yield the price doesn't go down, the yield doesn't go up. Okay. That's a very, very different scenario than what we've been used to. The last time anything like this was done was back in the 1940s during the wartime, the Second World War. Because you follow these policies in order to incentivize production, incentivize growth, but at the same time, you don't want interest rates to go out of control.
So the crisis is at least as big as World War II.
That may be one way to put it. I think the bigger issue is just how the amount of leverage which has built up in the system, which is what I described with that chart over there. And how do you sort of, extract your way from that? I mean, there is no easy answer to it, to be perfectly honest. You sort of have to hope that over a period of time, you can work some of that debt off the system. The technology advances enough so that you can get new things. But then technology also has the other side to it, that by itself, technology is deflationary. It brings down prices of things. I mean, it can, of course, encourage economic activity, but a lot of the economic measures we have today were built for the industrial age. Trying to apply them to the more digital age makes it seem like there is actually deflation.
That's a fascinating way to see it. Right?
Yeah.
That's a good way to see it.
Exactly. So
technology is deflationary.
Yes. Yeah. So by itself, it is deflationary. A lot of it may actually be good deflation as well. But just the way you measure it, which is like saying, you could have infinite number of copies of that particular software, to, take a simple example.
Right. It's happening in the OTT market as well.
Absolutely.
If there was just one OTT platform, it would have been deflationary compared to the cable TV. But now you subscribe to 5 of them. So, yes, the act plays out like that. So, Debashish, where does Indian economy stands amongst all this happening? Where do you see the Indian economy, the Indian markets heading into 2022? How does this affect us as well?
Yeah. So I don't think the Indian economy per se is all that different from what's going on around the world. There are a certain set of trends which are happening globally. And then there are certain things which are specific to India. Okay. Let's maybe look into that in a little more detail. So globally, what you have going on, as I described, was this policy of financial repression, right? Where effectively what you're trying to do is keeping the rates, the bond yields down and keeping inflation a little high. Okay. Which of course can, create a little bit of movement out of people allocating from fixed income and putting it into other asset classes. So that's the start. Let's just park that there. The second part to it is that you can't just have a policy and not have a narrative also. There has to be a narrative which is built around growth and which effectively causes this repression policy to work. The narrative really talks about essentially rebuilding everything. The term for it, which if you Google around and you'll find a lot of references from various global leaders, is called Build Back Better.
Yes.
And if you now look through everything which is trying to be built back better, whether it happens or not is a different matter, but what is trying to be built back better, you look at how supply chains are getting reset. You look at how energy, the whole energy system, the talk is about resetting it from a thermal fossil fuel based system to a more renewable sort of system. You look at how the financial industry is kind of, looking at a whole change from the classical banking model to the more fintech kind of thing. So there's this whole
DeFi
wave
sort
of, things which are happening. But you're also hearing, not just in India, but around the world, the need to build new infrastructure. Now, whatever that infrastructure is a very big, opaque thing, but you'll definitely hear that from place to place. A big driving force of a lot of these things is political. That you've got this problematic period of, say, 15, 20 years, where on one hand, technology is advancing fast enough, where you have the developments in various forms of automation. Maybe AI is just one form of that broader automation, but which is basically productivity enhancing. But what it also means is you need less people. But at the same time, the ability to skill that many people or even find areas where they can be deployed is not the simplest problem to solve.
The solution creates its own problems going forward.
Exactly. So therefore, you have to find ways to keep them occupied. Now, there are two ways you can keep them occupied. You can either, or let's say three ways to do that. You can either just pay them money to sit at home. That's one way. And that was kind of maybe what was happening in 2020.
In 2020,
right?
a bit of that was seen.
Yeah.
Yes.
You can either pay them to play video games effectively. And I think what you're seeing with NFTs and all those things is just a sort of, final outcome of that thought process.
Sneak peek. Yes.
Exactly. Or thirdly, you can try and find ways to engage them, at least from a politically where it can be explainable. So whether it is building infra, building these new energy sources, building these new things, a big umbrella term called Industry 4.0, which basically involves a completely different way of doing manufacturing and all that. So you've got all these things which are coming in. Now, these, to a large extent, are the narratives which will justify why these new things need to be built. But when you build new things, at least the one good part which happens out of it is that you have to go out and create a few new jobs. Now, you can even have extremes where people are simply getting paid so much to stay at home or making so much money in the market, so they don't even want to bother going to the new jobs. And maybe
is the big quit has
something like that.
Something to do with this?
Yeah, something like that. So you effectively create both the reason for inflation and the narrative for inflation, which can allow the rates of inflation to progress higher than where it is right now. You also follow a bit of a carrot and stick approach. On one side, you incentivize all these new productions, which means that if you're setting up all these solar plants, you'll get all these incentives. That's the kind of common policy which is being implemented all around the world. You also follow the stick approach, where you're saying that, okay, if you don't do this, then you have to pay carbon tax or some version of pollution tax or something or the other. Now, that's a very hard thing to argue against, right? I mean, who wants to be known as saying that I'm polluting the environment, right? I mean, you just can't.
Correct.
So when you combine that together, you bring together the financial reason for higher inflation, which is really, what we were talking about, this forced repression policy. And you bring about the narrative and maybe the future fundamental reason for all these things to happen. Then comes the issue of that, how do you finance all this? The carrot and stick may work well over here, because there is a limit to how much you can keep. I mean, theoretically, there is no limit. You can keep printing money, but it will be inflationary, of course, from time to time. But the other way to do it is that you create these issues with the supply chain, let's say. And if you create issues with the supply chain, somebody benefits, right? Either the materials companies benefit, the logistics companies benefit, maybe the power companies benefit. And then you have the stick, which says that, okay, now that this benefits which you're getting out of these supernormal profits you're making, redeploy that to bring about cleaner technologies and all of those things. So that's where you force things to go a certain way. What I'm also probably trying to say over here is that the world broadly is moving from being a very capitalistic world as we have known it or we've been told to believe, to one which is a lot more policy driven. Okay, so that's the first.
This is something you've touched. More broadly, how do you see the role of central banks ahead, not just in 2022, but this entire decade that's upon us? Do central banks sit back and watch the money machine work, or they every once in a while show up and do something drastic, which we have to factor in our decisions going forward?
So, firstly, the central banks are already active as of now. As of now, how they are active is by continuing to follow some amount of quantitative easing, even if you're tapering the amount of purchases and all of that. They continue to be active doing that. They may be forced to look at yield curve control at some point if inflation really starts taking off for whatever reason. Maybe they've bought themselves about a quarter and a half of breathing space, but it might come right back because of the reasons which I just described earlier. Now, whether that implementation happens just through central banks or through regulators as well in general, I think that remains to be seen. The bigger issue, I think, which central banks have to grapple with is again a complicated one, okay, which is we know how popular these cryptocurrencies have become. But let's go into the reason why they are popular. It's essentially saying that this particular policy of financial repression, which we have seen, where you let inflation run a lot higher than what the interest rates you get, means that your broader money system debases over time. Essentially, your fiat money system loses value over time. So if it's losing value over time, then I need to be redeploying money from the fiat currency system into something else. Now, what could that something else be? Of course, stocks are part of it. Commodities would, of course, be part of it. Certain amount of gold would be part of it. Art could be part of it, all those things. But also cryptocurrency, the very genesis of it lies right there. That it is, at least ostensibly, somewhere where, there is a limit to how much you can produce at least one particular currency. Of course, you can have any number of currencies, which is a different matter altogether. But at least that's the thought behind it. Now, by itself, trading the currency up and down doesn't mean anything, right? I mean, trading any Bitcoin or Ethereum by itself, that's not the problem. Okay. The problem is if adoption were to truly happen. And the reason is that all of these, there is the currency and then there is the protocol. The protocol enables you to build and trade value on top of that network. Okay. You trade the value using the currency, but it's really the value which is getting built on the network, and you enable that value to be traded, stored and traded using, whether it's the blockchain, whether it's those digitized assets, all that whole rabbit hole of Web 3.0 development, which is happening. Now, to give a more practical thing of what I'm trying to say over here is that maybe at 50,000 Bitcoin value, whatever that is, nobody cares. However, at $150,000 value of Bitcoin, there's a decent chance that Elon Musk would be selling Teslas in Bitcoin. Right? Apart from the fact that it would be a cool marketing thing, there is probably a fairly sound logic behind it, which is that currently
maybe sure if they aren't doing it already. Yes.
Yeah, they might be doing it already, but let's assume, hypothetically that they haven't done it so far. But what that would mean is any revenues which any companies are making today is parked in the corporate treasury. What is the corporate treasury holding? It's basically holding bonds for the most part. Bonds are nothing but the price you put on the current financial system or the current currency system. Now, if you feel that the currency system itself is debasing, why on earth would you be owning those bonds? So you would want to diversify. Sure. Historically, you would have gone and allocated maybe 5% to gold and something else to, some other thing. That's where you go and start saying, okay, I'll just I'll accept payments in Bitcoin, Ethereum, whatever, the currency might be, and take it from there. But that is the exact nightmare scenario for central banks, because it means that effectively they lose control over the system. Because when you go down that whole rabbit hole of this protocol and the blockchain and the ability to essentially, have decentralized systems whether it's a financial system or some other decentralized system, you just completely take away the power that the authorities have over you. So
they've spent
Yeah.
300 odd years trying to build this system,
Exactly.
perfect this system. They won't want the system to go away overnight just because some anonymous person made something behind. Right.
That's exactly right. And especially at a time where they are essentially trying to get, you could say, I mean, if their intentions were honest enough, you could say that they're essentially trying to repair a highly levered system. Now, whether it's truly repairable or not, I think only time will tell. But that would be the worst time possible to try and give up control over a currency and your monetary policy and,
Agreed.
So
if you find yourself riding a tiger, keep riding. That's what
where.
you do. Yeah.
So I think the real thing to really watch out for is how, if we get into a scenario, let's say over the next 6-7 months, where you have the simultaneous rise of at least the prominent cryptocurrencies and maybe even, some of the other related inflationary assets, whether it's emerging markets or gold or whatever, might be in sympathy with all that. And you have bond yields also rising swiftly enough, which puts a risk to the collateral values of the derivative system. That's exactly where they probably will need to step in and do something about it. Now, whether they do it in the form of yield curve control or some other more draconian measure, that I think we'll just have to see. So that's what we really sort of setting up for.
Right.
Now,
one of the interesting things that you touched upon it was that this has been happening in the commodities super cycle that is going on. All major commodities have been on a tear post-pandemic. There is a lot to unpack here. So first question would be, how does ESG play into this? Because one way ESG can have impact here is to reduce the availability of funds to black and brown sectors like you touch on carbon and such like, to decarbonize them, which can have knock-on effects later. For example, natural gas spikes, we saw a sharp rise in power bills in Europe. So how do you think ESG and the equity markets are implicated by this?
So ESG is just the fancy term for that carrot and stick approach which I was describing. What is your objective? You do want to create that higher rate of inflation so you can run a repression policy. You also don't want the world to collapse, while you're at it. So you try to bring about these policies which would create growth, and at the same time put a sort of almost like a full stop to the previous system, the previous economic system, if you will. Now, if one part of that economic system involved mining products and supplying it, ESG puts a bit of a blocker on all that.
Right.
Where essentially you get penalized if you go ahead and follow all these practices to mine. Now, keep in mind, what we're talking about here is various things which will increase the broader electrification of the economy. Right? Whether it's just using more gadgets, electric vehicles, so on and so forth. Yet you are not, because of ESG considerations, not being allowed to burn that much fossil fuels. You also happen to make electricity a fairly tradable kind of thing, which means the financial market participants can also get behind it and ramp up prices if they need to. And then you essentially bring in these policies which kind of force this transition to happen. It's almost natural that the price of those commodities, the price of that energy and all of those will go up because you've effectively cut off the existing supply. And yet the new things you're creating require that supply to come in. Okay. So that's the carrot. Those companies are then able to produce supernormal profits, but they will be forced to deploy those profits into making those green changes and all of those things, which in turn help new things to get built. What that could result in is that we may have a few years period where you see supernormal profits for, let's say, a power company. But the new form of producing power, which is through solar and all these things, is actually decentralized. You can have a big plant, but you can as much have, thousands of houses with rooftop solar on top of it.
Correct.
The higher the prices go, the more you incentivize this change to happen. So effectively, you're using the market forces to make this happen. So there'll be this painful period where first things probably move up in price, whether it's energy, commodities, and all of that. And then suddenly where you have this oversupply. So when you look at it from an investing standpoint, maybe the first part is really looking at folks who would benefit from this, supernormal sort of cycle of higher commodity prices, higher energy prices, so on and so forth. Now, we'll see how long that continues, because if you make a lot of those underlyings financially tradable, they could run a lot longer, whether it's energy, power, etc.
Interestingly, touching upon this, the other dimension is that the fiscal spending, like the US infra bill that came up, supply-demand imbalances like that we saw with the semiconductor shortages that are going on, moving away from just the time investors in systems, could also be causing a sharp demand for commodities. Is my thinking right here? Is this what you touched upon?
Yes. I mean, elements of it. Specifically, semiconductors is just one part. Okay, because for semiconductors, it's really about that whole silica chain coming in, and there could be a whole geopolitical angle to semiconductors, which is not necessarily as linked to this. But what you saw with power, what you've seen with various commodities, what you're seeing with the agricultural commodity side as well, it's all interlinked, because you create these issues with the supply chain, you create issues of high shipping rates. What do you effectively achieve out of it? You effectively, force that transition to happen. You force these new supply chains to get created. You force, the companies effectively to fund their new transitions by using that extra normal profits which they end up getting. So it's just a whole lot of things packed in together, and which obviously makes it an increasingly complex environment. To semiconductors, it may be a little more to do with the specific US-China issue and who gets their hands. I mean, if you just look at it very calmly and just leave aside the political angle, it makes a lot of sense for China to be acquiring Taiwan and Australia.
Okay.
Right? Now, whether that truly happens, doesn't happen, then there is probably a rationale to it that why having a semiconductor shortage at this point would help. That you don't necessarily want it to go into various areas. And there's a reason probably the likes of TSMC is going and setting up massive manufacturing units now in different parts of the world.
Right. India has been on this as well.
Well, they're
trying
to get in on this. I think India still, doesn't really have an ecosystem
far
yet.
lagging behind.
Yeah.
Yes.
So that may be part of it. But I think definitely what you saw with gas, what you've seen with commodities, the various industrial commodities like copper, aluminium, etc. I think, they all play into this whole thing. Nothing's going to be a straight line. I mean, it'll all be part of that up and down cycles. But that's really the new world we are moving into, where there is this carrot and stick, there is this policy-driven approach, and there is this transition towards building new things, which will be justified using various narratives, and then how the financial markets sort of, action that further, because all these things are tradable, right? Everything from carbon taxes is tradable to metals, of course, are tradable. And if everyone knows that this is what's going to happen, why would you not be allocating more to it and causing prices to go up, or, finding a base for prices? So that's really the world we're kind of moving into.
Agreed. Debashish, we have actually gone into a part where mental models are breaking down because we are so deep into the macros. Let's take a step back. How you read these frenzied market environment where everything is going up. Narratives matter more than fundamentals. People have stopped looking on the accounts at all. I don't want to say we're in a bubble, but let's go with irrational exuberance, if that's a better word. What's your mental model of sorts to think about these markets? Are they a product of the system, or are they, bad byproducts of the system?
No, I don't really think they're irrational at all. At a headline level. I mean, of course, there can be pockets which, get into frenzy. That's natural. Because what have you really done? You've essentially said that, okay, I'm capping interest rates, even if not explicitly, I'm kind of keeping it a lot lower. So where else do I put my money? Right? I mean, whether it's the US, which has 10-year bond yields at 1.5%, which means if you just invert that bond yield, it becomes the effective PE ratio. And if you invert 1.5, that comes to what, 66 PE or something is justified, right? I mean, by that logic. I think more appropriately, it just tells you that parking money in bonds is a waste of time. Let me go ahead and park in anything. Also, at the same time, you're you're debasing the currency system. So if you were to divide the value of the asset by the expansion in the balance sheet of the central banks or the sort of expansion in the base money creation which is happening, then it will not look as extreme. Because the base money has probably gone up 3x, 4x. So if you divide whatever the 2x, 3x upside which we might have had on various equity markets around the world, by that amount, we're probably not even above water at the moment. So I think it's a very rational response.
To tie it back to all the things, what are some dominant themes you think will unfold because of this? I know you've written a lot about agriculture and VC interest there, for example. So how does it all tie in together?
Yeah, so the way I look at these things is that there is this whole, like I mentioned, range of policies which are being put in place. So you've got on one side what's really happening with the whole rebuilding of the supply chain. Which includes, the newer logistics chains, the newer materials, newer energy, all of those things which fall into that. When I look at something like agriculture, what I was mentioning was more specific to India, but still part of a global cycle again. So let's unpack that. Firstly, the global cycle. As I mentioned, we've got this financial repression policy, right? So financial repression means that you earn a lower yield on your bonds. So therefore, why would you be owning as much in bonds? You would want to diversify a certain part out of it. But as I'd shown in that graphic over there, you had almost 300 trillion in bonds. Whereas what you have in commodities would be a fraction of the global economy. So say somewhere in the range of, maybe 10, 15 trillion or something like that. And soft commodities would be a part of that. So even if you were to move 1 or 2% out of global bonds into commodities, whether it's soft commodities or hard commodities, you would set off a price appreciation. Okay. So that's one angle to it. Secondly, you would also cause fertilizer prices to go up. So a lot of things at the entry level, at the input level, start becoming more expensive. Then you can always have these weather patterns from time to time. I mean, those, of course, keep changing from one year to the other, but you can always have extreme weather events from time to time, which can cause, localized shortages to happen at a time when prices are also going up and less fertilizers are available because of the increase in prices. So which can cause yields to go up. So that's one scenario of agriculture playing out, but higher prices of agriculture do encourage activity in that space. So that factor should be kept in mind. So that's the first global backdrop to it. Now, when I look at it domestically, what's really happening is that now in India, agriculture has really been, relatively speaking, a subsistence activity. It's not really an industry also. I mean, of course, you have certain, agri-businesses around, but it's far less evolved when you compare it to any of the developed markets.
Developed nations.
Yeah. Yes. At the same time, there's obviously a lot of potential given, the size, the amount of arable land and all of those things. It's, of course, a political hot potato. So, there is no easy answer to it. But there is a transition, and that's a transition I bet on not just for agriculture, but India as a whole, which is moving from a low income economy to a middle income economy. That's almost like a core thesis I run with specific to India. And then I use those various global trends to see how it's playing out. And then I look at what's happening locally to figure out what to invest in.
Okay. Right. You started out by saying we are where China was in the 90s. So this is where...
This is exactly what it is. Now, when you move from a low income economy to a middle income economy, the kind of things which you consume changes. So you originally tend to consume more of cereals and rice and wheat. But as you move to a higher level of income, you consume more vegetables, poultry, meats, and essentially proteins and vegetables. You tend to consume them a lot more. Now that's sort of the global push which is happening for a lot of the VC funds to look at India. Because large parts of the rest of the world are actually aging, especially the Western world, China, Far East, all of these things. Now, when you go into an aging population, and these are, keep in mind, heavy protein consuming nations. Right. So when you go into an aging population in all these places, the amount of meat consumption and all of those things will come down in these areas. So there's a bit of a rebalance which is on between how trends play out over there when you look at food consumption and how trends play out in this part of the world. And it includes India and all the other sort of, countries in a similar state of, low income as well as, essentially making that transition. So that's like the other big trend. Now, when all of this plays out, then of course, agribusiness has to grow. Right. Now, the first factual, let's call it, representation of that happening is to actually see the VC activity which is going on. And what I see there is somewhat similar to what was happening in consumer tech 10, 12 years back, where you had a lot of companies getting those initial rounds of funding and maybe even, subsequent rounds, although the really big rounds maybe had not happened yet. And that enabled a whole consumer tech industry to get created, or in 2013-14, a whole fintech industry to get seeded and, put on the growth path. And I think something like that's happening here, where effectively an industry is getting created. About 1,000 companies have got funded. And over a period of time, you'll see that where talent, money, all of those things start moving in. You see a very diversified agribusiness industry which will build up. And maybe the trends globally of higher soft commodity prices will push things a little further down that road.
Mm-hmm. You staying domestic, you touched upon how the WPI inflation that's going on and some other inflationary pressures might be creeping in, especially with FII money going out of it. It generally happens. So how do you see RBI tackling inflation in the shorter term? What would be our modus operandi regarding this?
I don't particularly believe that we're running a monetary policy particularly independent of what the Fed is also going on. Which means to the extent you can talk down things, you will do that. Because in a recovering economy, you don't really want to go and start putting brakes on. Because the reality is it's not going to take a whole lot for things to slow down again. And, how much that affects you or me is debatable. Assuming there were a lockdown or something to happen tomorrow, but there is a wider section of society which definitely gets affected a lot more. And that matters a lot in the political outcomes. So at the same time, of course, you don't want runaway inflation and all those things to happen. So I would imagine they'd do something fairly similar to what's going on, which is try and talk things down. The core economic policy also for India, I think, really involves investing ahead of demand. Now, that's another big difference which happens when you move from a low income to a middle income economy. Now, we all automatically assume that when growth happens, inflation will happen. But unfortunately, as soon as that happens, it does slow things down. And therefore, you never really progress out of being a low income economy. The only way you progress out of moving from low income to higher income or a middle income sort of economy is that you substantially increase capacity. It's like saying if Zerodha is handling, say, 6 million customers today, what would it take for it to handle 50 million customers? And it may not be the perfect example, but in your case, where you may not necessarily need to expand things, but you'd still have to expand things, before you get there. Now, when you talk a more physical world with a lot of, real things moving back and forth, as opposed to just going through digital pipes, it's a more complex problem. So you definitely have to go out and build things for all that to happen. If you encourage that activity, you also enable a lot of micro and small medium enterprises to come up. in this transition, usually you would want a whole lot of that to happen. The more you have small and medium enterprises out there, the more you enable low inflationary growth to happen. So countries like whether it's China, US, Germany, Japan have all made that transition by using low inflationary growth, where they essentially widely expanded the capacities which they could handle. But it's a very different way of looking at investing, because in a normal consumption-driven economy which we have today, we always consume more, the demand happens, and then the supply comes in. And therefore you value all those things like, higher margins, being able to charge all that. Whereas you've got to look a little differently, that can you create that capacity? Can you create those economies of scale to happen, which then drive adoption? And maybe that whole geo example is a perfect way to explain that. You bring down costs, you drive adoption, and you create, you set up that capacity to handle that many people. And then the network effect of that results in a whole lot of businesses on top of it. That's how you look at these things. So.
Speaking about domestic and developed economies, one economy that usually isn't talked about much but is in highlight right now is the Turkish lira in Turkey. What's happening there? It seems that lira is falling as we speak. They had to stop their stock exchange for a couple times, if I'm correct. So what's going on in Turkey?
I mean, I won't profess to be any sort of expert on Turkey, but at the very headline level, to me, it seems a combination of possible mismanagement and possible geopolitics at play over there, depending on, which way the Turkish loyalties are swinging. I think there's a certain amount of that happening. There's a fair amount of Turkish bonds which trade in US dollars, which make it therefore, more open to all kinds of forces acting on it. As opposed to say, where in India you have a very small fraction which actually trades in dollars, right? So it doesn't impact things too much. In Turkey, it's very different. So it could just be a function of, this bigger game which is possibly happening between Russia on one side and US on the other, and Turkey sort of being in the middle of it, kind of playing both sides. And you've got, this dictator also who's sitting over there, who's essentially overridden every central banker and every sort of economic system over there. So that's what it is. But I think to go deeper into that, you'd probably have to get a Turkish expert on this.
So speaking about this, strangely, one of the major economies that has been relatively silent in all this steam-packed environment is China. One of the spotlights news that came in was the Evergrande crisis that was going on. So what happened? Was the crisis contained, or why is China so silent amongst all this news that is going around the world?
So I think compared to the rest of the world, China is probably already experiencing tightening. It's not tightening in terms of policy, but it's tightening in terms of their banking and credit system. Now, the fact that Evergrande may have had a problem and it would show up over time, I think it's the broader real estate space. And that's, part of it has been a problem, not since today, but for a while. If you were to even pull out the longer term chart of Evergrande, you'll see that it's actually been trending downward since 2017. So it's not like people in the know did not know. It was a crisis in the making for a while. The reasons for the crisis may have built up 5-6 years before that, in fact, when they were essentially building cities after cities which were not populated with people. And at some point, the debt would come calling. And I think that's kind of what's happening right now. The markets have obviously underperformed, and they simply reflect the fact that you've got a tightening and a bankruptcy situation which is going on over there under the radar. Not dissimilar to, I think, what we went through in 2018. But at a scale which is probably 50-60x of whatever we went through. If you were to just compare their real estate companies, like the biggest companies in India develop and sell about 10 million square feet a year. The likes of Evergrande, and there are quite a few more like them, build somewhere on the order of 450 million square feet a year. So it's a completely different order of, building and all these things which you're talking about. And some parts of that I think are unraveling. What I think this translates into is the need for them to follow some sort of expansionary policy sooner or later. The tricky part in all this is that how do they keep their currency pegged in that scenario? And I think that's going to be the fascinating part about how 2022 plays out. What the Chinese yuan does at a very macro level. And chances are you first get a bigger crisis, and then you get this intense reliquefaction effort, which in turn causes the yuan to start falling. But the fall in the yuan will have ripple effects across multiple other currencies.
Great.
So maybe that's a story for the second half of the year, and maybe the first half is more, still a rebalancing out of China and elsewhere. So we'll see how that plays out, but that's really where it is.
Interesting point. Touching upon this, to round up all the developments that have been going on and moving towards the conclusion of this session, it's that first thing, reading into macros or reading into the future is analogy-wise something very similar to reading crystal balls. So for how long of a period do you think the crystal ball is clear, and after how long does it become hazy and there are no signals to be had?
So
how far in the future can we realistically see into as of now as things stand?
So it's an interesting one. You can kind of see how these things are likely to play out over a period of time. And if anything else, actually taking a slightly longer view helps. Because all the things which I just described, right? You've basically got a highly levered world. You don't want that world to sort of go into Japanification and all of that. You want some growth and all those things to happen, because of which you have to follow a certain set of policies, whether that includes financial repression or, building new things, creating new jobs, whatever it might be. Okay, that's one set of things. Now that you can see it playing out, I mean, that's almost the logical thing any politician would do anywhere in the world and kind of make that happen. But to make it happen, there's a bunch of things which have to happen, which is the policies have to play out. And at the same time, as the policies are playing out, you have to ensure leakage doesn't happen into some sort of alternative universe, which is really the whole cryptocurrency and all of that system. Now, how do you sort of plug that and make it happen? That's, I think, where the big job for the central banks will come in the form of central bank digital currencies, where you have programmable policies and all those things. So how I'd put it is that you can see a path and you can see various signposts in it. What you don't know is whether that path will be exactly a straight line or will be a highly curved line to get there. But because those signposts exist, you kind of also know that the signpost will kind of tell you which direction it will go should that hit. So it's almost like a Bayesian algorithm for all you, folks in the tech world. If this set of things happen, this is what happens. So that it's that probability which you have to kind of keep evaluating at every point in time, which definitely makes it far more complex than what we've been taught. I think there's no doubt about it. I think if you're going in with that simplistic sort of, the speed, I mean, that may work. Look, I mean, I don't want to be, this thing, but I just think there's a whole bunch of things coming together, whether it's global policies, whether it's the advances in technology, whether even where we are sitting in right now, which is a fairly historical moment in our own evolutionary history.
Absolutely.
Which makes for a fascinating, period ahead, and possibly a very troublesome period ahead also in certain parts. Yeah.
This is what makes macro so interesting. There are like 5 million things going at once, and you make peace with the fact that you would not be able to factor in everything, but you still try to find, the highways that are being used to approach some thinking. So as a follow-up question to this, given the scenario that we're in, if an investor was to create or try to create a robust portfolio, you think about portfolio allocation, what would be some good rule of thumb, some good signposts, some good directions to go about it?
Yeah, so let me just share something over here, and maybe that may help. Yeah. So there's a little bit of thing which I just put out there, how to think about this kind of a scenario. I think as a base case, you have to take into account the fact that we're running into this financial repression world. And which means folks who might benefit out of that financial repression, you have to sort of look to build a core part of your portfolio around that. The various beneficiaries would really be what those narratives are built around, which I was describing to you, right? Whether how the energy shift happens, how the supply chain shifts happen. In a lot of those things, what you really have to do is try and figure out, try and go a little deeper and try and figure out where the risk versus reward is the best. Like if you're building a bunch of electric vehicles, just as an example, should you really be investing into the electric vehicle maker itself, or should you be investing into the, maybe some of the commodities which go into making an electric vehicle? And that's the kind of call you'll have to make from time to time. At times, one may be better, at times someone else may be better.
Right.
But all of these fall under the broader beneficiaries of financial repression. At the same time, the repression, as you mentioned, as you sort of described earlier, is a balancing act. And there will be times when the balance will kind of, fall off. And that's where market volatility will be significantly higher at that point, and more appropriately where downside risks are higher. That's what you'll have to look for and try and manage that. To give you an example, when you look at what just happened over the last 2 months, again, elements of this were visible in late October itself, where there is this trade called steepeners which unwound. Steepeners are essentially a very easy way to bet on higher inflation. If via higher interest rates, you basically bet on the fact that the yield curve will steepen. So the long-term bond yields will rise faster than the medium or low short-term bond yields. You play this through the derivatives market. So the investment bank will just, conjure up a magical piece where you'll make money if it steepens and you will not make money if it flattens. So these steepeners unwound sharply in late October, which would then suggest that sooner or later a lot of that inflationary trade would unwind. The markets were still at
this
their
in
peak.
anticipation of the FOMC meeting?
Whether it was an anticipation, keep in mind when these steepeners are being sold, somebody has sold them, right? So it's the big investment banks which have sold all these things. Or it could be a whole bunch of other players as well. But let's just assume, there's a bunch of people who've sold and there's a bunch of people who've bought those steepeners. If too many people
Who are the primary buyers of these?
I would assume if it was a very popular trade at the time, right? So if it's a popular trade, chances are all kinds of funds all over would have been buying these things. Even, large investors might have been buying it also wherever, whoever had access to, these kind of products. And therefore, it means that they are effectively short, sitting on the other side, and someone else obviously has taken the other side of the trade who's short inflation. So if certain policies or, certain announcements or some of those, things shape the other way, then that trade is going to be hugely profitable to the one who's effectively sold volatility or sold inflation over there, right?
Correct.
So, but the fact that unwound, more to our case, is that it was telling you that inflation trades will unwind. Now, then you can follow your own policy, whether you want to short the inflation plays, you want to just go slow and not invest right now and let it come back in and then buy again. So that's a call you take. And that's what, you run your portfolio for. So that's what it is. And that's the volatility management you'll have to keep building into your process. Within India, of course, like I mentioned, it's that broader shift happening from a low income economy to a middle income economy, which typically requires you to invest first and then see, demand come in, which means you have to invest in capacity first. Now, interestingly enough, there are a lot of global tailwinds supporting exactly that. So that makes life a little simpler. And then you can apply a simple enough filter, which is that are the advances in tech going to play a constructive role or a disruptive role for the areas that you're looking at? The easiest way to distill macro is to bring it down to sectors. And then when you look at a sector, just take that call. Okay, do I think tech will play a disruptive or a constructive role to the existing, companies which are already there? Which is where you take a bit of a call between, what's the weightage of these sectors already in the index? If the weightage is pretty high, it typically tells you that the incentive for people to disrupt is very high, right? Because you can make supernormal profits doing that. On the other hand, if it's really low, nobody cares. Right. So those are some of the tricks you'll have to use to navigate this environment.
So now we'll be going through our closing questions. So they become a little more personal, a bit more micro, if I might say.
Sure.
So how do you personally invest? What's your personal investment philosophy? Not only at Oak, even before you were a part of it.
Sure. No, what I've implemented at Oaks is pretty much what my personal investment philosophy also is, which is that can I find areas where it's relatively ignored at the moment, but where things could change, and it ties in with what's happening globally as well, because that really gives the tailwind. Then I don't need to be the best stock picker in the world. I'm just trying to be in the right broad, path. So if back in 2010, when I see that, the previous regime, when it kind of started, 2009, 2010, I would have had a bunch of consumer companies. I had some of those, automobile kind of companies. I had some of the technology plays. I mean, there was this unknown ETF run by Motilal at that time. For a long time, nobody knew it existed. I just found it a complete no-brainer. And I pretty much had it from, the earliest days when I got to know about it. So all those things are there. Now, when I look at it, the other side, I keep tabulating it against, okay, what's already known in the markets? Where are people already positioned for? And therefore, what's the next thing which I can look at? Now, to give you a perfect example.
So you never try to time the markets at all?
No, of course I do.
Go with the broad trend.
Of course I do. I do try to time.
Okay.
What I'm trying to say is I first try to look at the bigger picture. What are the trends playing out? What's happening? To figure out what are the areas I should be spending time on. I mean, when you start off in the markets, you kind of want to start looking at everything, right? But then you realize that just doesn't work. There's just no way anyone can have the bandwidth to, look at multiple things. So you got to narrow it down to areas where you can build better competence in. Except that the areas change. I mean, there are certain times when certain things work better. Other times, other things work better. I've just had the benefit of, going through experiences in multiple markets. So, just seeing a bunch, lots of different things. But yeah, it comes back to that. Figuring out that broader area. Once that broader area has got figured out, then it's about timing. Okay. What are the prices at which I want to buy, where effectively I can buy a cheap call option on growth? That's the way I look at it. Of course, it needs to be in a big area. It's, got, growth potential, all those good things. Right. Good management.
That's a good way to put it.
Yeah.
A cheap call option on growth.
But yeah, that's exactly what I'm trying to do. Can I get a cheap call option on growth? And then comes the timing of the buying, which is that, in the last decade, timing would have been a stupid thing to do, right? I mean, essentially any price you bought would have been fine. And you would be stupid even to try and time. You should have just shut your brain and bought it at any price possible. But if you see over the last 2 months, it's again turned out to be a good thing, right? Where if you're actually only active on the bad days, just by doing that, you can actually, get a better outcome versus, what the indices are doing.
There are some good deals in the market.
There are some good deals from time to time. I mean, there always are, right? There always are. And at the same time, I wouldn't want to discourage a short seller. I mean, there can also be deals on the other side. It's just harder as a short seller. You have to, find those things and hope a whole lot of things are going wrong so that you can ride, some parts of it and then be nimble enough to also get out at the right time. So I think timing definitely matters. It's just been undervalued in the last decade since it didn't matter. But when I started out, it did matter. It did matter when you came in and all those things. Volatility levels were a lot higher. So that's where, timing, looking at charts, all of those things, I think, come into play very much when I get down to the actual act of investing. Once I've figured out the broad areas I want to be looking at.
Right. So Debashish, just a fun question. One thing that reassures retail, those smaller players, is that when the bigger players also fail to see something or make a trading investment mistake of sorts, we all have our fair share of, being blindsided by the markets, such is the nature of the beast. So what was one particular time where you think, looking back in with the powers of hindsight, that you made a mistake or you failed, you got blindsided by the markets, if there is such a story?
I don't think I really got blindsided particularly. For the most part, some of these big trends are fairly, you can figure it out. Now, you may not know exactly when it will happen, but as I was giving that example of the pandemic, you may not know a pandemic is going to happen, but you can see that the excesses in the market exist. Similarly, when I look at it right now, the narrative is all negative, but when I see the broader leveraging of the financial markets, it's not that high. And there is scope for that to go up, and which is what makes me kind of bullish going into next year. And the fact that so much of a correction has also happened in the last couple of months, I don't think it's as negative as what it may seem if I were to just look at the markets today and all that.
When you were starting out your career, you mentioned you were a part of the NASDAQ crash and subsequent following crashes. Did you see those coming in, or they were a surprise, like right into the market?
No, I had no clue about markets, although funnily enough, I had an interview at one of those companies, on campus, and in Feb 2000 I probably made the call of the decade when I said sell tech and buy cement or something like that. I had no clue about it, to be honest. I just saw someone else who followed the markets being very worried every day when he came into the room with the way the markets were rising.
Really interesting.
There's nothing more to it than that.
Something you can know about a person a lot is by the books or the educational resources that they use. So if there were some books or podcasts or movies that you'd recommend to people which will help them understand the markets a little more, which books would those be?
I think in terms of books, a fundamental read for everyone is Reminiscence of a Stock Operator, Edwin Lafayette, which is, the classic one. I think understanding trends, trading it, all of that, I think there is no better one. I always found, One Up on Wall Street pretty useful, just in terms of building a simple enough model to understand companies, especially the more, or shall I say the more consumer focused companies. It's a bit easier to do that. Probably less so for the other, more industrial kind of companies, but that's there. There's another book which I found very insightful, which not many people know about, is called Running Money by this gentleman called Andy Kessler. He was a guy, he was one of those, part of that whole Morgan Stanley investment banking team, which was, in the pre-NASDAQ era, which was one of the most well-known, well-sought-after teams for the amount of deals which they did. Then he ran a hedge fund for a period of time, managed to sell at the right time. But just the way he understands this whole, the way this whole digitized economy works and the lead up which he gives from how the industrial age used to work, I think it really enables you to think through centuries and how trends unfold over time. So I'd highly recommend that. There are probably tons more, but I think these three are a good place to start with.
Right. Having read the first two, I'd surely be reading this. Running Money, is it's called?
Running Money by Andy Kessler. Yeah.
Yes, so I'll be reading this for sure.
Yeah. In terms of podcasts, I think I do like to track what the Real Vision folks are up to constantly, because I just think the kind of talent which they're able to get together because of their own connects and all of that just makes it, very rich in content, where it doesn't matter who you are, whether you're an experienced market practitioner or you're someone who's starting out new. Very rightfully, they don't try to dumb down the content. Not make it those banal buy this,
right.
That kind of stuff. It's involved enough, because today I think with Google and everything, whoever's interested can, actually go and learn. That's how I taught myself global macro to start with. I just, heard things and I then Googled around and, did all that stuff. So I think all of that is possible, and they really cover a vast range. So it's pretty useful to do that. And the rest, I think, is just being aware, following what's happening, follow the money.
Debashish, thank you so much. This is where our session concludes. And it only concludes for this episode. We'll have more episodes, more discussions going forward. You are always a pleasant sight here at Zero Dark.
Sure. All right.
Thank you so much, Debashish.
Thanks for doing this.
And
Bye-bye.
with this, we have come to the end of this session. Take care. Keep listening. See you next time.
This show is intended entirely for learning and informational purposes only. Please don't construe this as trading advice or a solicitation to trade. All the statements made herein are the individual views of the host and should not be construed as an opinion put forth by Zerodha or Rain Matter.